Stop for a moment and think about the stories that grab our attention. The comeback kid, the Hail Mary pass, the long-shot bet that promises to change everything. We are wired to love the dramatic turnaround, the heroic effort against impossible odds. In the world of investing, this attraction is a fatal flaw. It's a siren song that lures countless investors onto the rocks of financial ruin. We see a company on the brink of collapse with a charismatic new CEO promising a revolution, and we think, this is it. This is the 10-bagger. This is the story I'll tell for the rest of my life. We bet on the miracle, and almost every single time the miracle never comes. The laws of business gravity are relentless. Companies with deep, complex, systemic problems rarely solve them. The turnaround fails, the revolution fizzles out, and the investment evaporates. This is the path of the 99%, a portfolio built on hope, prayer, and a collection of lottery tickets masquerading as stocks. But there is another path, a quieter, less dramatic, and infinitely more profitable one. It's a path forged by a man who has become synonymous with wealth itself, a man who has compounded capital at a rate that defies financial logic for over 60 years, Warren Buffett. And his secret isn't about finding the next technological revolution or betting on corporate resurrections. It is, in fact, the exact opposite. He articulated this principle with his trademark simplicity. I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over. This single sentence is one of the most profound and valuable pieces of investment advice ever uttered. It's a complete philosophy, packed into 14 words. It is the genetic code for building a portfolio of low-stress, high-probability winners. It is a promise. Not a promise of a single spectacular win, but a final promise of a lifetime of winning. This is a deep dive into that promise. We are going to deconstruct this 1-foot hurdle principle into its fundamental pillars. This isn't about stock tips or market timing. It's about installing a new operating system for your financial mind. You will learn to see the market not as a casino of exciting gambles, but as a landscape of businesses, some facing unclimbable mountains and others facing small, simple hurdles. By the end of our journey, you will possess the framework to filter out the noise, avoid the traps that ensnare the majority, and begin building a portfolio that compounds wealth with the quiet, predictable force of gravity. You will stop betting on miracles, and you will start investing in inevitabilities. This is the guide to finding simple stocks that just keep winning. The entire edifice of the 1-foot hurdle strategy rests on a single, non-negotiable foundation. It's a concept so critical that without it, you cannot even begin to judge the height of a hurdle. You will be blind, guessing in the dark, mistaking a 7-foot wall for a simple step. This foundation is the principle Buffett credits more than any other for his success, the circle of competence. Before you can analyze a business's problems, you must first be able to honestly, brutally, and accurately analyze the limits of your own understanding. The first hurdle every investor must clear is not in the market, it is in the mirror. To truly grasp the power and the pain associated with this idea, we must travel back to the late 1990s. The world was in the throes of a technological frenzy, unlike anything seen before. The dot-com bubble. It was a time of pure euphoria. Companies with no profits, no revenues, and often no viable business plan were going public and seeing their stock prices multiply overnight. The Nasdaq index was a rocket ship, soaring from 1,500 in 1998 to over 5,000 by early 2000. Stories were everywhere, of secretaries becoming millionaires, of college kids dropping out to launch startups that would supposedly change the world. A new paradigm had arrived, the old rules of valuation were declared dead, and anyone who questioned the frenzy was labeled a dinosaur, a relic of a bygone era. And the chief dinosaur, according to the cacophony of media and market commentators, was Warren Buffett. For years, Berkshire Hathaway had been delivering breathtaking returns, but as the 1990s roared to a close, Buffett was sitting on the sidelines. He wasn't buying Pets.com, he wasn't investing in Webvan. He refused to touch the high-flying tech darlings that were making everyone else rich. Berkshire Hathaway's stock, for the first time in a long time, was underperforming the market, and drastically so. The pressure was immense. Shareholders were grumbling. The media was merciless. A cover story in Barron's in December 1999 was titled, "What's Wrong, Warren?" The article was brutal, suggesting that Buffett, then 69, had lost his touch. He was a master of old-world businesses, insurance, railroads, consumer goods, but he just didn't get the new economy. He was an analog man in a digital world. At the annual Berkshire Hathaway meeting, known as the Woodstock for Capitalists, shareholders would line up at the microphones and question him directly. "Warren," they'd ask, with a mix of reverence and frustration, "why are we missing this? Why are you letting the greatest wealth creation engine in history pass us by?" And Buffett's answer was always the same, delivered with unnerving calm and consistency. He would say, "We have no insight into which of the hundreds of internet or technology companies will emerge as long-term winners. We will not invest in businesses we cannot understand and cannot evaluate." He would explain that he couldn't with any certainty project the cash flows of these companies 10 or 20 years into the future. He didn't know what their competitive advantages would look like, or if they would even exist in a decade. They were, for him, outside his circle of competence. He wasn't saying they were bad investments. He was saying he didn't know enough to tell if they were good ones. And for Buffett, if you don't know, you don't play. It was an admission of ignorance, a radical act in a world where everyone pretended to be an expert. He was happy to look foolish in the short term rather than be foolish in the long term. We all know what happened next. Starting in March of 2000, the bubble burst with spectacular violence. The Nasdaq, which had peaked above 5,000, collapsed. Over the next 2 years, it would fall nearly 80%, wiping out an estimated $5 trillion in market value. Companies that were once the darlings of Wall Street went bankrupt. The new paradigm was revealed to be the same old speculative mania, dressed in new clothes. And Warren Buffett, the dinosaur, looked like a prophet. By sticking to what he understood, he preserved Berkshire's capital, avoiding the carnage completely. When the dust settled, he had a mountain of cash ready to deploy into the wonderful, understandable businesses that had been thrown out with the bathwater, buying them at bargain prices. His discipline wasn't about being anti-technology. It was about being pro-certainty. He understood that the biggest risk is not knowing what you're doing. The 1-foot hurdles he looks for are only visible within the bright, clear light of his own understanding. Outside of it, in the fog of the unknown, every hurdle looks like a monster. The psychological principle that Buffett masterfully navigates here is one of the most pervasive and dangerous cognitive biases in all of human decision-making, the Dunning-Kruger effect. This phenomenon, identified by psychologists David Dunning and Justin Kruger, describes a cognitive bias whereby people with low ability at a task overestimate their ability. In short, people who don't know much about a subject often don't know enough to realize just how little they know. Their incompetence robs them of the metacognitive ability to recognize their own incompetence. This is the engine of the amateur investor's destruction. Think about the dot-com bubble. A retail investor hears about a company with a hot new technology. They read a few news articles, they see the stock price going up every day, and they listen to confident-sounding experts on television. This small amount of information creates an illusion of knowledge. They feel like they understand the business. They might not be able to explain what a burn rate is, or how the company plans to achieve profitability, or what the competitive landscape looks like 5 years from now, but they feel they have the gist of it. They mistake familiarity with a story for genuine competence in business analysis. This overconfidence leads them to invest, often heavily, in a business they fundamentally do not understand. Buffett's circle of competence is a direct antidote to the Dunning-Kruger effect. It is a conscious, deliberate act of intellectual humility. It's drawing a line in the sand and saying, on this side of the line is what I know with a high degree of certainty. On that side of the line is everything else, the realm of speculation and gambling. The power of this approach is that it protects you from your own worst enemy, yourself. Your ego wants to be part of the hot trend. Your brain is susceptible to the compelling stories of revolutionary change. Your fear of missing out screams at you to jump on board. The circle of competence is the discipline that says no. It forces you to operate only where you have a genuine, demonstrable edge. For Buffett, that edge was in understanding the durable economics of businesses like Coca-Cola, American Express, or Geico. He could sit down and calculate with reasonable certainty how many cans of Coke would be sold next year and the year after. He understood the psychology of brand loyalty and the mathematics of an insurance float. These were businesses with predictable earning streams and understandable competitive advantages. When he looked at a high-flying tech stock in 1999, he couldn't do that. The range of outcomes was too wide. It could be worth $1 trillion, or it could be worth zero. That kind of uncertainty is thrilling for a gambler, but it's poison for an investor. By refusing to stray into that territory, Buffett wasn't just avoiding individual bad stocks. He was sidestepping a domain where his own psychological biases would have worked against him. He knew that outside his circle, he too would be just another victim of the illusion of knowledge. So how do you, as an entrepreneur or a retail investor striving for financial freedom, apply this? How do you translate this powerful theory into a practical mental model? The blueprint is a simple but profound exercise I call the 3 buckets method. This isn't about creating a complex spreadsheet, it's about creating clarity. You take a piece of paper or open a document and you draw 3 columns. The first column, bucket 1, is labeled Businesses I Understand Inside and Out. This is your core circle of competence. Be brutally honest here. This isn't about what you wish you knew. It's about what you actually know. The easiest place to start is your own profession. If you've been a software engineer for 15 years, you likely have a deep understanding of enterprise software companies. You know the players, you know the sales cycles, you know the technological moats. If you're a doctor, you understand the dynamics of healthcare, pharmaceuticals, and medical device companies far better than the average analyst. Perhaps you have a lifelong hobby. If you've spent every weekend for 20 years restoring classic cars, you have a visceral understanding of the automotive parts industry. Write these industries and specific business models down. This bucket should be small. For most people, it will only contain a handful of areas. This is your hunting ground. These are the businesses where you can spot a 1-foot hurdle because you understand the terrain. The second column, bucket 2, is labeled Businesses I Could Understand with Dedicated Effort. This is your learning zone. These might be industries that are adjacent to your profession, or hobbies that you're deeply interested in. For example, the software engineer might put consumer technology in this bucket. The doctor might put health insurance companies here. The key is that you have a foundation to build upon and a genuine interest that will fuel the hard work required to move an industry from bucket 2 to bucket 1. This involves reading annual reports, studying industry primers, listening to conference calls, and truly learning the language and economics of the business. This bucket represents the potential for expansion of your circle, but you must not invest in anything from this bucket until you have done the work to confidently move it into the first. The third column, bucket 3, is the most important for wealth preservation. It's labeled the too hard pile. This is where you practice your intellectual humility. This is where you list all the businesses and industries that, for whatever reason, are beyond your ability to understand and evaluate with certainty. For Buffett, this was tech in 1999. For you, it might be biotechnology, complex derivatives, or cryptocurrency mining. There is no shame in having a large, too hard pile. In fact, a large and well-defined too hard pile is the hallmark of a wise investor. It is the fence that protects your capital from your own ignorance. Every time you hear a hot tip about a company in this bucket, you don't even need to think. You just say pass. It's a pre-made decision that saves you from temptation and from the Dunning-Kruger effect. The ongoing practice is simple. Focus 95% of your research time on the companies within bucket 1. Spend the other 5% exploring one topic from bucket 2, and completely ignore everything in bucket 3. This is how you build a portfolio based on knowledge, not speculation. It is the practical application of Buffett's greatest secret, transforming a vague concept into a clear, actionable plan for any investor seeking to improve their long-term investing results. To fully appreciate the wisdom of this path, we must dedicate some time to exploring its opposite, the path of the 99%. This is the world of the hot tip chaser, the antithesis of the disciplined, competence-focused investor. This individual operates without a filter. Their investment decisions are not driven by deep analysis but by external stimuli. They might be at a barbecue when their brother-in-law, who knows nothing about finance, breathlessly tells them about a small cannabis company that's, quote, guaranteed to be the next big thing. Without any due diligence, without even reading the company's financial statements, they log into their brokerage account and buy. Their reasoning is based on social proof and a compelling story. Another common trigger is the media. A talking head on a financial news network pounds the table about a revolutionary 3D printing stock. They speak with conviction, using exciting jargon. The stock chart shown on screen has gone straight up. This triggers a powerful psychological response, FOMO, the fear of missing out. The 99% investor doesn't ask, what are the unit economics of this business? What is its competitive advantage? What is a reasonable valuation? Instead, they ask, how do I get in on this before it goes even higher? They are not investing in a business. They are chasing a ticker symbol, a line on a screen. Consider the phenomenon of meme stocks in recent years. Hordes of retail investors, connected by social media, piled into companies not based on fundamentals, but based on a collective narrative, a shared joke, or a desire to stick it to the establishment. They bought shares in struggling video game retailers or movie theater chains, not because they had carefully analyzed their balance sheets and determined they were undervalued, but because it was exciting. It was a movement. For a brief period, many of them saw incredible gains on paper, but it was a game of musical chairs. The underlying businesses were often facing 7-foot, even 70-foot hurdles. When the music stopped and the narrative faded, the stocks collapsed, wiping out the savings of those who got in late or didn't get out in time. This is the inevitable outcome of investing in Bucket 3. It's a strategy based on luck, timing, and being part of a crowd. It has nothing to do with the CEO mindset or a disciplined approach to stock picking. The financial connection between strictly adhering to your circle of competence and your actual portfolio growth is direct and profound. First, it dramatically reduces unforced errors. The single biggest destroyer of wealth for most investors is not picking the wrong good stock, but buying into a business they don't understand that subsequently blows up. By never venturing into your too hard pile, you eliminate the category of mistakes that leads to a minus 100% return. Preserving capital is the foundation of all successful wealth management. Second, it allows for true, high-conviction investing. When you invest in a business from your Bucket 1, you understand its value. You know its strengths and weaknesses. So when the market panics and the stock price drops 30% because of some scary headline, you don't panic sell. Instead, if the underlying business fundamentals haven't changed, you see it as a wonderful opportunity to buy more of a great business at a cheaper price. The investor who bought the hot tip, however, has no such foundation. They don't know why they bought it other than it was supposed to go up. When it goes down, they are terrified. Their lack of understanding creates fear, and they sell at the bottom, locking in their losses. Your competence gives you the courage to be greedy when others are fearful, a cornerstone of beating the market. Finally, operating within your circle simplifies the entire process of stock analysis. You can read the annual report, the 10K, and actually comprehend what management is saying. You can build a reasonable valuation model because you understand the key drivers of the business. This clarity of thought is a massive competitive advantage. While others are chasing complex narratives and trying to predict the unpredictable, you are focused on simple, understandable businesses, waiting for a simple one-foot hurdle to create a buying opportunity. This discipline doesn't just improve your returns, it reduces your stress and allows you to build wealth methodically, creating a clear path towards financial freedom. It is the bedrock upon which all other principles are built. Once you have firmly established the boundaries of your circle of competence, you can begin the real work, identifying the one-foot hurdles. This is where we move from internal self-assessment to external business analysis. The market is a sea of companies, each facing its own unique set of challenges. The average investor is drawn to the drama of the monumental challenge, the corporate turnaround, the technological moonshot. Buffett, however, has trained himself to look for the opposite, a great business facing a simple, temporary, and solvable problem. This is the anatomy of a one-foot hurdle, and mastering the ability to identify it is what separates the professional from the speculator. Perhaps the single greatest case study in the history of this principle unfolded in the winter of 1963. It was a story that had all the makings of a disaster: fraud, scandal, and Wall Street panic. It involved a company called American Express. At the time, Amex was primarily known for two things: its traveler's checks, which were a dominant form of payment for tourists, and its burgeoning credit card business. But it also had a lesser-known division involved in warehousing. One of its major clients was the Allied Crude Vegetable Oil Refining Company, run by a man named Tino De Angelis. Allied borrowed huge sums of money from Wall Street banks, using its inventory of salad oil, stored in American Express's warehouses, as collateral. The receipts for this oil, certified by Amex, were considered as good as gold. The scandal broke when it was discovered that Tino De Angelis was a master con artist. The giant tanks in the warehouse weren't full of salad oil. Most of them were filled with water, with only a few feet of oil floating on top for inspectors to see. The total fraud was estimated at over $150 million, a colossal sum at the time, equivalent to well over $1 billion today. The banks that had lent money against the phantom oil were facing catastrophic losses, and they turned to American Express, claiming that Amex's warehouse receipts were guarantees. The market panicked. The perception was that American Express, a company built entirely on trust and financial integrity, was now on the hook for a massive, unquantifiable liability. The stock, which had been trading at over $60 a share, was eviscerated. It plummeted to $35. Wall Street analysts and financial commentators predicted doom. They saw a 7-foot hurdle, possibly an insurmountable one. They believed the scandal would permanently tarnish the Amex brand, causing people to lose faith in its core traveler's check and credit card businesses. This is when a young 33-year-old Warren Buffett, running his small investment partnership in Omaha, got interested. While the rest of the world was focused on the headline, the fraud, the scandal, the potential liabilities, Buffett asked a different, much simpler question: has this scandal actually changed the behavior of the company's customers? He decided to do his own primary research, what he called scuttlebutt. He didn't just read analyst reports, he went out into the real world. He visited banks and travel agencies. He talked to the tellers and agents, asking them if customers were still buying and using American Express traveler's checks. The answer was a resounding yes. He then went to restaurants and hotels in his hometown and asked them if they were still accepting the American Express card. Again, the answer was yes. Buffett reasoned that the average consumer and business owner either didn't know about the salad oil scandal or they didn't care. They didn't connect the esoteric warehousing division with the green card in their wallet or the traveler's checks in their travel pouch. He concluded that the company's primary economic engine, its powerful brand, and its payment ecosystem was completely untouched by the crisis. The problem, while serious, was contained to one division and was ultimately a quantifiable financial loss. It was a 1-foot hurdle. It was a hit to the balance sheet and a PR nightmare, but it was not a mortal wound to the core business. While Wall Street was paralyzed by fear, seeing an existential threat, Buffett saw a world-class business on sale at a ridiculous price due to a temporary problem. He famously invested 40% of his partnership's assets into American Express stock. Over the next few years, the company settled the liabilities, the scandal faded from memory, and the core business continued to grow spectacularly. The stock soared, and Buffett's partners made a fortune. He had stepped with ease over a hurdle that everyone else thought was a wall. The psychological trap that ensnared the rest of the market in the salad oil scandal is a powerful cognitive bias known as salience bias, often working in tandem with the availability heuristic. Salience refers to how much something stands out or grabs our attention. The story of the great salad oil scandal was incredibly salient. It was a dramatic tale of fraud, deception, and massive financial loss. It was front-page news. The availability heuristic is our mental shortcut of judging the likelihood of an event by how easily examples of it come to mind. Because the story of the scandal was so available and so vivid in everyone's minds, they dramatically overestimated its impact on the fundamental business of American Express. The market's thinking went something like this: I keep hearing about this terrible Amex fraud. It's all over the news. Therefore, American Express must be a deeply troubled company. Its reputation is ruined. People will stop trusting them. This is a lazy emotional conclusion driven by the most prominent information. It requires no real work. Buffett's genius was in consciously overriding this bias. He recognized that the loud, scary, salient information, the scandal, might not be the most important information. The most important information was quiet, boring, and required effort to uncover. Were people still using the cards and checks? He effectively ignored the noise to seek out the signal. By physically going to merchants and banks, he was gathering data that was not readily available in newspaper headlines. This data, the mundane reality of continued consumer habit, was far less salient, but infinitely more important for valuing the business. He was able to see that the market was suffering from a massive case of short-termism and emotional overreaction. It was fixated on the one-time loss and the embarrassing headlines, and it was completely ignoring the decades of future profits that the durable consumer franchise would generate. The one-foot hurdle strategy is, at its core, a form of cognitive arbitrage. It's about exploiting the market's tendency to overreact to dramatic but temporary problems. You profit by staying rational when everyone else is succumbing to the salience of a scary story. You train your brain to ask, is this problem truly a business killer, or is it just a loud, distracting, but ultimately solvable issue? The difference between those two answers is often the difference between a catastrophic loss and a multi-bagger investment. So how can we systematize this kind of thinking? How do we build a repeatable process for distinguishing between a one-foot hurdle and a seven-foot wall? The applied mental model for this is the problem-solution litmus test. It's a simple yet powerful framework that forces you to define the problem and its solution with ruthless clarity. It consists of 3 steps. Step 1. Clearly define the problem in a single, simple sentence. You must strip away all the jargon and media hyperbole. What is the actual root problem the company is facing? In the case of American Express, the problem was the company faces a large, one-time financial liability and a reputational crisis due to fraud in its warehousing division. It wasn't Amex is going bankrupt or no one will ever trust Amex again. A clear definition is the essential first step. If you cannot define the core problem simply, it's a sign that the situation is likely too complex, a 7-foot hurdle. Step 2. List the company's available resources to solve that specific problem. This is a crucial reality check. Does the company have the tools to fix this? For Amex in 1963, the list of resources was formidable. They had a strong balance sheet with significant earnings power from their core business. They had a world-class brand that, as Buffett's research showed, was still highly trusted by its core customers. They had a competent management team capable of navigating the legal and financial fallout. They had the resources to absorb the loss, settle the claims, and move on. Step 3. Describe the solution in 1 or 2 simple sentences. This is the litmus test itself. A one-foot hurdle has a direct and obvious solution. For Amex, the solution was, use the company's earnings power and balance sheet to cover the financial losses over time, and execute a public relations campaign to reassure the public of the brand's integrity. Notice how simple and linear that is. It doesn't require a miracle. It doesn't depend on 5 different things going right in perfect sequence. Now, contrast that with a 7-foot hurdle. Let's take a struggling retailer trying to compete with Amazon. Step 1. The company's brick-and-mortar business model is becoming obsolete due to a fundamental shift in consumer behavior towards e-commerce. Step 2. What are its resources? A weak balance sheet, declining sales, expensive physical leases, and a brand associated with the old way of shopping. Step 3. What's the solution? Well, they need to build a world-class e-commerce platform, reinvent their entire supply chain, retrain their workforce, create a compelling new brand identity, and somehow offer a better value proposition than one of the most dominant companies on earth, all while their core business is bleeding cash. That is not a simple linear solution. It's a complex, multi-stage, bet-the-company prayer. It is a classic 7-foot hurdle. By applying this simple 3-step test, you can quickly filter out the hopeful turnarounds from the high-probability opportunities. The path of the 99% is to be endlessly seduced by the allure of the 7-foot hurdle. This is the turnaround trap. The story is always intoxicating. A fallen giant, a once great company that has lost its way. A new, visionary CEO is brought in, often from a highly successful company like Apple or Google. They give inspiring interviews, talking about transformation, disruption, and a bold new vision for the future. Investors fall in love with the narrative. They bet on the hero, the savior CEO who will single-handedly reverse the tide of history. A textbook example is the story of J.C. Penney. In 2011, the struggling department store hired Ron Johnson, the genius behind the Apple Store's incredible success. The market was ecstatic. The narrative was perfect. The man who created the world's best retail experience was going to save the department store. Johnson announced a radical plan to eliminate coupons and sales, the very things that drove J.C. Penney's core customers into the stores, and replaced them with fair and square, everyday low prices and trendy stores within a store. He was trying to solve a monumental problem, the slow, grinding death of the mid-tier American department store. Investors who bet on this turnaround were not betting on a 1-foot hurdle, they were betting on a miracle. They were betting that Johnson could fundamentally change the shopping habits of a generation of budget-conscious consumers. The result was an unmitigated disaster. The core customers, confused and alienated by the new strategy, fled. New, younger customers never materialized. Sales plummeted, cash burned at an alarming rate, and the stock price collapsed, wiping out shareholders. Ron Johnson was fired just 17 months after he started. The problem wasn't that he was a bad executive. The problem was that the hurdle was 7 feet high. The company's fundamental business model was broken, and no amount of visionary leadership could easily fix it. The average investor consistently makes this mistake. They overweight the power of a charismatic leader and underweight the power of the underlying business economics. Buffett does the opposite. He says he wants a business that's so good, an idiot could run it, because sooner or later, one will. He focuses on the height of the hurdle, not the perceived jumping ability of the jockey. The direct financial connection between focusing on 1-foot hurdles and building a successful investment portfolio is most clearly seen in the predictability of a company's free cash flow. A company facing a 1-foot hurdle, like a product recall, a temporary PR crisis, or a manageable lawsuit, might see a short-term dip in its earnings and cash flow. The American Express scandal caused a one-time financial hit, but its long-term cash-generating ability, driven by its powerful consumer franchise, remained perfectly intact. An investor could look at the business and confidently project that, after the storm passed, the river of cash would continue to flow. This predictability is the holy grail of long-term investing. A company attempting to clear a 7-foot hurdle has the exact opposite financial profile. Its future cash flows are a giant question mark. The struggling retailer trying to reinvent itself will have to spend billions of dollars on capital expenditures, CapEx, to build new distribution centers and technology platforms. They will burn through cash on marketing to try and attract a new type of customer. They might have to issue new shares, diluting existing shareholders, just to stay afloat. Their future is a binary outcome. It either works spectacularly or they go bankrupt. There is no middle ground. This is a gamble, not an investment. By filling your portfolio with businesses facing one-foot hurdles, you are constructing an engine of predictable growth. You own a collection of companies whose future cash flows are highly probable, not just possible. This stability is what allows the magic of compounding to work. It lowers your stress because you're not constantly worried about a bet-the-company transformation going off the rails. It increases your hit rate because you are making high-probability bets on solvable problems, not low-probability bets on miracles. This is the core of a professional approach to wealth management and the surest path to predictable portfolio growth. Now we arrive at a deeper layer of the analysis. We have established the need to stay within our circle of competence and to identify businesses with simple, one-foot hurdles. But a critical question remains. What makes a hurdle 1 foot high for one company and 7 feet high for another? The answer, more often than not, lies in the presence of a powerful and durable competitive advantage, what Buffett famously calls an economic moat. The moat is the business's built-in problem solver. It's an invisible force field that protects the company from competition and gives it the strength and flexibility to easily step over challenges that would crush a weaker enterprise. A strong moat shrinks problems. A weak or non-existent moat turns every gust of wind into a hurricane. To understand this concept in its purest form, we must go back to 1972 to a transaction that Charlie Munger has said was one of the most important in shaping Berkshire Hathaway's investment philosophy. This was the acquisition of See's Candies. On the surface, it was a simple, even boring business. It was a chain of candy shops, primarily in California, selling boxed chocolates. There was no cutting-edge technology, no grand vision to change the world. But Buffett and Munger saw something extraordinary beneath the surface. They saw a business with one of the most powerful moats they had ever encountered. The story begins when they were offered the company for $30 million. Buffett, still deeply rooted in the cigar-butt investing style of his mentor Ben Graham, initially thought the price was too high. The company had tangible assets, factories, stores, inventory, of only about $8 million. Paying a huge premium over book value was not his typical style, but Charlie Munger pushed him to look deeper, to see the value of the intangible asset that didn't appear on the balance sheet: the See's brand. For decades, See's had cultivated an incredible reputation for quality and nostalgia. It was the go-to gift for birthdays, Valentine's Day, and Christmas in California. Generations of customers had a deep emotional connection to the brand. When a man was in the doghouse with his wife, he didn't buy a generic box of chocolates from the supermarket. He went to See's. This intense brand loyalty gave See's a phenomenal competitive advantage: pricing power. They could raise their prices by 10% every year, and no one would even consider switching to a competitor to save $1 or $2. The emotional connection completely overrode the price consideration. This pricing power was the moat. It meant that See's faced a perpetual one-foot hurdle. The challenge for any business is how to grow earnings in the face of inflation and competition. For a normal business, this is a constant, difficult battle. They have to fight for every dollar. But for See's, the solution was laughably simple. Every year, after Christmas, they would just mark up the prices on all their products. That was it. That was their entire growth strategy. And it worked, year after year, like clockwork. The moat, the customer's love for the brand, made this hurdle vanishingly small. Buffett and Munger bought the company for $25 million. It was a pivotal moment. See's became the prototype of the kind of business they would look for from then on. A wonderful company with a durable moat that they could buy at a fair price. See's required very little additional capital to run, yet it gushed cash. Over the decades, it has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that Buffett could then use to buy other wonderful businesses. The initial $25 million investment became a fountain of capital. It was a lesson in the immense financial power of a great brand. A business with a wide moat can step over hurdles like inflation, rising input costs, and new competition with an ease that a commodity business could only dream of. The psychological forces that create and sustain a moat like the one See's Candies possesses are deeply ingrained in human nature. Two of the most powerful are the endowment effect and status quo bias. The endowment effect, identified by behavioral economist Richard Thaler, describes our tendency to value something more highly simply because we own it or feel a connection to it. For a See's customer, it wasn't just any box of chocolates. It was their box of chocolates. It was tied to memories of family, celebrations, and happiness. This endowment made the product far more valuable in their minds than its objective ingredients. They weren't just buying candy, they were buying nostalgia and a feeling of tradition. This ties directly into status quo bias, which is our natural preference for the current state of affairs. Change is uncomfortable. Making new decisions requires cognitive effort. When a See's customer needs a box of chocolates, the easiest, most comfortable decision is to simply go back to See's. The decision is already made. It's automatic. To switch to a different brand, even a cheaper one, would require effort. They would have to research the new brand, wonder if the quality is as good, and risk the social faux pas of giving an inferior gift. The path of least resistance is to stick with what you know and trust. A powerful moat exploits these biases masterfully. A great brand becomes the default choice, the status quo. The hassle of switching to an alternative, combined with the emotional connection from the endowment effect, creates a powerful lock-in. This is why companies with strong moats have such predictable revenue streams. Their customers are not fickle. They are held in place by these invisible psychological tethers. As an investor, when you identify a business that benefits from these deep-seated human tendencies, you're not just betting on a good product, you're betting on the predictability of human behavior. This is how you find businesses that can weather economic storms and consistently overcome the small hurdles of day-to-day business, allowing for exceptional long-term investing performance. To make this practical, we need a mental model for actively identifying these moats in the wild. The Moat Identification Checklist is a framework that helps you categorize and evaluate the strength of a company's competitive advantage. Before you invest in any company, you should be able to clearly identify and articulate which of these moats it possesses and why it is durable. There are 4 primary types. First is the brand moat, which we saw with See's Candies. The key question to ask is, can this company consistently raise prices without losing significant business to competitors? Think of Apple. They can charge a premium for their iPhones, and their loyal customers will gladly pay it. Think of Coca-Cola. It's just sugar water, but the brand allows it to command a higher price and a larger market share than any generic cola. A strong brand is a license to print money. Second is the network effect. This occurs when a product or service becomes more valuable as more people use it. The classic examples are credit card companies like Visa or MasterCard. The more merchants that accept Visa, the more valuable it is for consumers to have a Visa card. And the more consumers who have a Visa card, the more essential it is for merchants to accept it. It's a virtuous cycle that creates a nearly impenetrable moat. Social media platforms like Facebook exhibit the same characteristic. Your friends are there, so you need to be there. This makes it incredibly difficult for a new competitor to gain a foothold. Third is high switching costs. This moat exists when it is expensive, time-consuming, or just a major pain for a customer to switch to a competitor. Think about the bank you use for your checking account. Moving all your direct deposits, automatic bill payments, and linked accounts to a new bank is a massive hassle. So you stick with your current bank, even if another one offers a slightly better interest rate. Enterprise software companies like Microsoft are masters of this. An entire company trained on Windows and Office is not going to switch to a different operating system just to save a few dollars. The switching costs, in terms of retraining and disruption, are immense. Fourth is the cost advantage. This is the ability to produce a product or service at a significantly lower cost than competitors. This allows the company to either offer lower prices to gain market share or to enjoy higher profit margins. Walmart's massive scale and hyper-efficient supply chain allow it to sell goods cheaper than almost anyone. Geico's direct-to-consumer insurance model gives it a structural cost advantage over competitors who rely on expensive agent networks. Your job as an investor is to run every potential investment through this checklist. Does it have a moat? If so, which one? How strong is it? A company with no identifiable moat is playing in a dangerous game where every problem, every competitor, and every economic downturn is a 7-foot hurdle. A company with a deep, wide moat has a powerful, built-in shock absorber. To truly understand the value of a moat, we must examine the antithesis, the plight of the 99% who invest in commodity businesses with no competitive advantages. The perfect example, and one Buffett has famously railed against for decades, is the airline industry. Think about it from the perspective of our moat identification checklist. Brand moat? Almost zero. Most travelers book their flights based on one single factor: price. They will happily switch from United to American to save $20. There is no brand loyalty. Network effect? Not really. An airline gets more efficient with a hub-and-spoke system, but the customer doesn't care if the plane is full or empty. Switching costs? None. You can fly a different airline for every trip with zero hassle. Cost advantage? Extremely difficult to maintain. The industry is characterized by brutal price wars, high fixed costs, planes, fuel, labor, and powerful unions. Because there is no moat, the airline industry is a graveyard for capital. Any small problem becomes a crisis. A spike in jet fuel prices can wipe out all profits. A labor dispute can ground the fleet. A new, low-cost competitor can enter a route and trigger a devastating price war. An economic recession causes travel demand to plummet, but the high fixed costs remain. Every single challenge is a 7-foot hurdle. Buffett learned this the hard way with his investment in U.S. Airways in 1989. Despite his aversion, he was lured in by what looked like an attractive price. The investment quickly soured, and he spent years extricating himself from it. He later quipped, "If a capitalist had been at Kitty Hawk, he should have shot Orville right. He would have saved his descendants a lot of money." Investing in a business with no moat is like being in a perpetual price war. It's a race to the bottom, and it's a terrible environment for the predictable compounding of wealth. The financial manifestation of a strong economic moat is crystal clear on a company's financial statements. A company with a moat will almost always have high and sustainable gross margins. Because they don't have to compete solely on price, they can maintain a healthy spread between their revenues and their cost of goods sold. A commodity business like an airline or a steel mill will have thin, volatile gross margins. Even more importantly, a great moat leads to a high return on invested capital, or ROIC. ROIC measures how efficiently a company is using its capital to generate profits. Businesses with strong moats, like See's Candies, are what Buffett calls capital light. See's didn't need to build massive new factories or spend billions on research and development to grow. It just needed to maintain its stores and its brand, and the cash kept flowing in. This allows the company to generate enormous profits without requiring huge reinvestment. That excess cash can then be returned to shareholders through dividends and buybacks, or be reinvested in other high-return projects, creating a virtuous cycle of wealth creation. This is the engine of portfolio growth. Companies with no moats, like airlines, are the opposite. They are capital-intensive. They have to constantly spend billions on new planes just to stay in business. They generate very low returns on that massive capital base. As an investor aiming for financial freedom, your goal is to fill your portfolio with high ROIC businesses protected by deep moats. That is how you harness the power of compounding and avoid the industries that are designed to destroy capital. We have now established 3 critical pillars: operating within your circle of competence, identifying simple 1-foot hurdles, and ensuring the business is protected by a durable economic moat. But there is a 4th, crucial element that can make or break an investment, even when the other 3 are in place. This is the quality and character of the management team. Buffett uses the analogy of a horse and a jockey. He wants to invest in a great horse, the business, but he also wants a great jockey, the CEO, in the saddle. While he has famously said that you should look for a business an idiot can run, he prefers to invest in one run by a superstar. The right management can skillfully navigate a one-foot hurdle, preserving and enhancing shareholder value. The wrong management, however, can inexplicably turn a simple one-foot hurdle into a self-inflicted, seven-foot wall of their own making. Buffett's ideal manager is not the slick, charismatic, visionary CEO who graces the covers of magazines. He looks for something much rarer: rational, honest, and shareholder-oriented leaders who think and act like owners. There is no better embodiment of this ethos than the story of Rose Blumpkin, the legendary founder of the Nebraska Furniture Mart, better known as Mrs. B. Her story is a masterclass in the kind of management that Buffett seeks to partner with. Mrs. B was a Russian immigrant who arrived in America in 1917, unable to speak a word of English. In 1937, with a $500 loan, she started a furniture store in the basement of her husband's shop in Omaha, Nebraska. Her business philosophy was brutally simple and effective: sell cheap and tell the truth. She was a fanatical operator, working from dawn until dusk, possessed of an almost supernatural ability to buy goods at the lowest possible price and pass the savings on to her customers. She built the Nebraska Furniture Mart into the single largest home furnishing store in the United States, a juggernaut that drove nearly every other furniture store in Omaha out of business. In 1983, Warren Buffett, then already a famous billionaire, decided he wanted to buy the company. He went to see the 89-year-old Mrs. B. He asked her a single question: "Is there anyone else we'd have to compete with?" She replied, "No, we're the only ones, we kill 'em all." Buffett was so impressed by her character and her business record that he made a deal right there on the spot. He bought 90% of the company for $60 million. The entire transaction was done with a 2-page contract and a handshake. There were no audited financials, no teams of investment bankers. Buffett was buying the business, but more importantly, he was buying Mrs. B. He was betting on the jockey. The story gets even better. Mrs. B continued to run the store with the same relentless energy. A few years later, at the age of 95, her family, concerned for her health, forced her into retirement. Mrs. B was not the retiring type. Furious, she left the company she had founded, and, after her non-compete agreement expired, she opened a brand new store right across the street. It was called Mrs. B's Clearance and Factory Outlet. It quickly became the third largest carpet retailer in Omaha. She was now directly competing with the business Buffett owned. Instead of getting angry, Buffett was delighted. He saw this as further proof of her incredible talent and drive. In 1991, he went to see her again and, with another handshake, bought her new company and brought her back into the fold. He recognized that a manager with that much passion, integrity, and business acumen was an asset more valuable than any factory or storefront. Mrs. B continued working until she was 103 years old. She embodied the Buffett ideal: a manager who treated the shareholders' money as if it were her own, because for most of her life, it was. The core psychological framework Buffett uses to evaluate managers like Mrs. B is designed to solve what economists call the principal-agent problem. This is the inherent conflict of interest that exists in most public companies. The shareholders are the principals. They are the owners of the company. The management team, the CEO and other executives, are the agents. They are hired to run the company on behalf of the owners. The problem is that the agents' interests are not always aligned with the principals' interests. A CEO might be more interested in building a larger empire than in maximizing per-share value for the owners. This can lead to reckless, value-destroying acquisitions that increase the size of the company and the CEO's pay and prestige, but harm the shareholders. A CEO might be focused on short-term stock price performance to maximize their own stock options, leading them to cut corners or engage in accounting gimmickry that sacrifices the long-term health of the business. They might use corporate funds for lavish perks, expensive headquarters, and private jets, treating the company's treasury as their personal piggy bank. Buffett's entire approach to evaluating management is a search for leaders who have transcended this problem, who genuinely think and act like owners. He looks for a few key tells. First, a passion for the business itself, not just the financial rewards. Mrs. B loved selling furniture. The money was a byproduct. Second, a rational and disciplined approach to capital allocation, which we will discuss later. And third, candor. He wants a manager who is honest with shareholders in both good times and bad. He wants a leader who will talk about their mistakes openly, rather than blaming them on external factors. This honesty is a powerful signal that the manager sees shareholders as true partners, not as a nuisance to be managed. Finding a CEO who has solved the principal agent problem in their own mind is like finding a golden ticket. It dramatically reduces the risk of your investment being squandered by self-interested leadership. So how can you, as an outside investor, get a read on the character and competence of a management team you'll likely never meet? You can't rely on their polished media interviews or promotional videos. You need a more reliable tool. The applied mental model for this is the shareholder letter test. The CEO's annual letter to shareholders is one of the most valuable, yet most overlooked, documents in the investing world. It is a direct communication from the agent to the principal. By reading the last 3 to 5 years of these letters, you can gain incredible insight into the mind of the CEO and the culture of the company. Here's a simple checklist to use as you read. First, does the CEO candidly admit mistakes? Every business makes mistakes. A great leader owns them, analyzes them, and explains what they learned. A poor leader either ignores them, hides them in obscure footnotes, or blames them on the economy, the weather, or bad luck. Look for intellectual honesty. Buffett's own letters are famous for the section where he details his errors of omission and commission. This builds immense trust. Second, do they talk about metrics that actually matter to owners? A good CEO talks about increasing intrinsic value per share, return on invested capital, and free cash flow. They focus on the things that make the owners richer over the long term. A promotional CEO talks about vanity metrics like the size of their empire, their brand engagement, or adjusted EBITDA, earnings before I take out all the bad stuff. They are trying to spin a narrative, not report on business performance. Third, is the language clear and straightforward, or is it filled with corporate jargon? Great leaders, like Mrs. B, speak in plain English. They want their partners, the shareholders, to understand the business. Leaders who use dense, impenetrable jargon are often trying to obscure a lack of performance or a flawed strategy. As Buffett says, it's not the prose that counts, but the message. If you can't understand what they're saying, it's often because they don't want you to. By applying this simple test, you can develop a surprisingly accurate picture of the person running the company. You can filter for the honest, owner-oriented jockeys and avoid the slick promoters. This is a crucial step in ensuring that the great business you found won't be run into the ground by poor executive decision-making. The antithesis to Buffett's approach of betting on rational, owner-oriented managers is the dangerous and widespread phenomenon of investing in the cult of the visionary CEO. This is the path of the 99%. They become infatuated with a charismatic leader who makes grand pronouncements and promises to change the world. They stop analyzing the business and start worshiping the individual. The story becomes more important than the numbers. A prime example is the saga of WeWork and its co-founder, Adam Neumann. Neumann was a master storyteller. He wasn't just renting office space. He was elevating the world's consciousness. He was a magnetic, compelling figure who convinced sophisticated investors to pour billions of dollars into his company at astronomical valuations. Investors who bought into the WeWork hype were not looking at the company's horrific unit economics or its massive cash burn. They were buying the vision. They were betting on the cult of personality. They ignored the glaring red flags of a CEO who demonstrated a clear disregard for shareholder interests. Neumann engaged in numerous related party transactions, leasing buildings he personally owned back to the company, and even charging the company millions for the right to use the We trademark that he had personally registered. His focus was on breakneck growth and building a personal brand, not on creating sustainable per-share value. The entire house of cards came crashing down when the company attempted to go public, and the harsh light of regulatory filings exposed the disastrous financials and the shocking self-dealing. The story evaporated, the visionary was ousted, and the valuation plummeted by over 90%, incinerating the capital of those who had bet on the charismatic leader instead of the business fundamentals. This is the danger of falling for the siren song of the visionary. The shareholder letter test and a focus on the principal agent problem would have immediately disqualified a leader like this from any serious investor's consideration. The most direct and financially significant connection between management quality and portfolio growth lies in one crucial function: capital allocation. This is the CEO's most important job. Every year, a successful business generates cash. The CEO must decide what to do with that cash. There are 5 basic options. 1. Reinvest it back into the core business. New factories, R&D. 2. Acquire another business. 3. Pay down debt. 4. Pay a dividend to shareholders. 5. Buy back the company's own stock. How a CEO makes these decisions over time will have an enormous impact on the long-term return you receive as a shareholder. A great capital allocator like Buffett himself thinks like an investor. They will only reinvest capital in projects that they believe will earn a high rate of return. They will only make acquisitions when they can buy a business for less than its intrinsic value. They will buy back stock only when they believe it is trading at a discount. They are disciplined, rational, and always focused on maximizing the long-term value per share. A manager like Mrs. B was a natural at this. She instinctively knew the best use of a dollar to generate more future dollars. A poor capital allocator, often the visionary empire builder, does the opposite. They might overpay wildly for a strategic acquisition that destroys shareholder value. They might pour money into pet projects with low returns. They might issue stock to fund these ventures, diluting existing owners. Even a great business, a horse with a wonderful economic moat, can be ruined by a jockey who is a terrible capital allocator. This is why evaluating management is not a soft, fuzzy concept. It is a hard-nosed financial necessity. The quality of a CEO's capital allocation decisions will be one of the single biggest drivers of your compounded annual growth rate over the long run. Choosing to partner with skilled capital allocators is a foundational element of beating the market. We have now reached the final pillar, the point where all our analysis and preparation culminate in a single action, the purchase of a stock. You have found a wonderful business that you understand completely. It's protected by a deep economic moat, it's run by honest and able management, and it's currently facing a simple, solvable one-foot hurdle. You have found the perfect investment, but there is one last piece of the puzzle that is absolutely critical. You must buy it at the right price. Investing in a great company is only half the battle. Buying it at a great price is what determines your ultimate return. This is the pillar of patience and price. The discipline of waiting for the market to offer you a fat pitch and then acting decisively. To see this principle in action, we turn to one of Buffett's most famous and brilliant investments, his purchase of the Washington Post Company in 1973. At the time, the Washington Post was a fantastic business. It had a dominant newspaper in a major city, which gave it a powerful local monopoly and tremendous pricing power with advertisers. It also owned several other valuable media properties, including Newsweek magazine and multiple television stations. It was a business with a wide and durable moat. It was also run by an outstanding manager, Katharine Graham, a woman Buffett deeply admired for her integrity and courage. However, in 1973, the stock market was in a deep funk. The Nifty 50 bubble had just burst, and the country was mired in recession and stagflation. On top of the general market malaise, The Washington Post was facing its own set of one-foot hurdles. There were fears of a newsprint shortage, and the company was embroiled in a small but noisy labor dispute. These temporary problems, combined with the overall market pessimism, created a cloud of negativity around the stock. Wall Street was fearful. The company's stock, which had been as high as $38 a share, collapsed to under $6. This is where Buffett's genius for price and patience came into play. He had done his homework. He analyzed the business not as a flickering stock quote, but as a collection of assets. He calculated what a rational private buyer would pay for the entire company. He estimated that the whole business was worth at least $400 million, or about $80 per share. Yet, due to the market's fear and obsession with temporary problems, the company's total market capitalization had shrunk to just $80 million. He could buy $1 worth of prime, cash-gushing assets for just 20 cents. The one-foot hurdles had created the ultimate bargain. Buffett didn't nibble. He acted with conviction. Over a period of several months, he patiently accumulated shares, eventually investing over $10 million and becoming the company's largest outside shareholder. He wasn't trying to time the bottom perfectly. He was simply buying a wonderful business at a price that offered an enormous, quote, margin of safety. The market eventually recovered its senses. The labor dispute was resolved, the newsprint fears faded, and investors once again recognized the incredible value of the Post's media franchise. The stock began a multi-decade climb. Buffett's initial $10 million investment would eventually become worth over $1 billion, a staggering 100-fold return. This is the power of combining a great business with a great price. The hurdles created the opportunity. The patience to wait for the right price created the legendary return. The psychological principle that allows an investor to act like Buffett in this situation is the mastery of one of Ben Graham's most enduring allegories, the story of Mr. Market. Graham asks you to imagine that you are partners in a private business with a man named Mr. Market. Every day, without fail, Mr. Market comes to you and quotes a price at which he is willing to either buy your share of the business or sell you his. The crucial thing to understand about Mr. Market is that he is a manic depressive. On some days, he is euphoric. He sees nothing but a rosy future for your business and offers to sell you his share at a ridiculously high price. On other days, he is utterly despondent. He is consumed by fear and pessimism, sees nothing but trouble ahead, and offers to sell you his share for a fraction of its true worth. The amateur investor, the 99%, allows Mr. Market's mood to dictate their own. When Mr. Market is euphoric and stock prices are high, they feel confident and buy aggressively. When Mr. Market is despondent and prices are low, they become fearful and panic sell. They are a slave to his emotions. The professional investor, the student of Graham and Buffett, treats Mr. Market very differently. They see him not as a guide but as a servant. They are happy to ignore him on the days when he is irrational. But on the days when his depression leads him to offer a wonderful business at a silly price, they take advantage of his offer with glee. Buffett's purchase of the Washington Post was a perfect example of this. In 1973, Mr. Market was in a deep depression. He was so terrified of temporary problems that he was willing to sell his share of a fantastic business for 20 cents on the dollar. Buffett simply recognized this manic behavior for what it was and calmly took the other side of the trade. The principle is simple but not easy. Your financial success depends on your ability to use Mr. Market's moods to your advantage, not be infected by them. The cognitive bias of loss aversion makes this difficult. Our brains are wired to feel the pain of a loss about twice as strongly as the pleasure of an equivalent gain. This is why it feels so terrifying to buy when stocks are falling. Every instinct screams at you to sell, to stop the pain. The discipline to overcome this instinct and buy when there is blood in the streets is what separates the great investors from the rest. To turn this into a practical, repeatable process, we use the mental model that is the cornerstone of all value investing, the margin of safety. This concept, also from Ben Graham, is the ultimate tool for risk management and return optimization. It's an engineering principle applied to finance. If you're building a bridge that needs to hold 10,000 pounds, you don't build it to hold exactly 10,000 pounds. You build it to hold 20,000 pounds. That extra capacity is your margin of safety. It protects you from miscalculations, unforeseen stresses, or bad luck. In investing, the margin of safety is the discount between the market price of a stock and your conservative estimate of its intrinsic value. Here is a simplified, three-step guide to applying it. Step 1. Calculate a conservative estimate of the business's intrinsic value. Intrinsic value is the discounted value of the cash that can be taken out of a business during its remaining life. There are many ways to estimate this, from complex discounted cash flow (DCF) models to simpler methods like looking at what a rational private buyer would pay for the whole company. The key word here is conservative. Use conservative growth rates and profit margins. You want to be reasonably sure that the business is worth at least this much. Let's say you analyze a company and conservatively estimate its intrinsic value to be $100 per share. Step 2. Set your required margin of safety. This is a personal choice, but a common range is between 30% and 50%. A 50% margin of safety means you are only willing to buy a stock when you can get it for half of what you believe it's worth. This builds in a massive cushion for error. If your valuation is a little off, or if the business stumbles a bit, you are still protected. In our example, with an intrinsic value of $100 and a desired 50% margin of safety, our target buy price is $50 per share. Step 3. Do not buy the stock until the market price falls to or below your buy price. This is the test of patience. The stock might be trading at $70 and it might look attractive, but your discipline says no. You wait. Mr. Market might never offer you your price. In that case, you move on. There are thousands of other stocks, but when he does have a moment of panic, when a 1-foot hurdle spooks him and the stock drops to $50 or $45, you act decisively. You buy, knowing that you have a powerful combination of a great business and a deep discount, which provides both a high probability of profit and a low probability of permanent loss. This disciplined process is the final execution of the 1-foot hurdle strategy. The antithesis of this patient, price-disciplined approach is the behavior of the 99%, which is driven by FOMO, the fear of missing out. This is most prevalent during roaring bull markets and speculative bubbles. An investor sees a stock, perhaps in a hot sector like artificial intelligence or electric vehicles, that is going up 5% every single day. Their friends are bragging about the money they're making. The media is filled with stories of instant wealth. The FOMO becomes overwhelming. They don't do a careful valuation. They don't demand a margin of safety. They just want in. They buy the stock at a price that bakes in decades of flawless execution and hypergrowth. Their purchase price has no margin of safety. In fact, it has a margin of terror built right in. When the story inevitably changes, when growth slows, when a competitor emerges, the stock price collapses because there was no valuation anchor, no cushion of safety. The FOMO buyer who bought near the peak is wiped out. They were not investing, they were performance chasing. They confused a rising stock price with a good business, and a high price with a good investment. The discipline of demanding a margin of safety is the only reliable vaccine against the deadly virus of FOMO. The direct financial connection between the price you pay and your future returns is undeniable and mathematically certain. It is the single biggest determinant of your compounded annual growth rate, CAGR. Let's illustrate with a simple example. Imagine a great company, Predictable Inc., that you have conservatively estimated will grow its earnings and intrinsic value by 10% per year for the foreseeable future. Now let's consider two scenarios. In scenario A, you give in to FOMO and buy the stock when Mr. Market is euphoric at a price of 30 times its annual earnings. 10 years later, the company has grown as expected, but the market has come to its senses and now values the stock at a more reasonable 20 times earnings. Even though the business performed well, your own annual return as an investor would only be about 6%. The high starting price ate up most of your gains. In scenario B, you are patient. You wait for a 1-foot hurdle to create a temporary panic. You buy predictable ink when Mr. Market is despondent, at a price of just 15 times earnings. 10 years later, when the market values it at 20 times earnings, your annual return as an investor would be over 14%. By paying a lower price for the exact same business, you have more than doubled your long-term compounded return. This is not a small difference. Over an investing lifetime, this is the difference between modest portfolio growth and the achievement of true financial freedom. The price you pay is the anchor of your returns. By patiently waiting for the 1-foot hurdle to provide you with a margin of safety, you are not just reducing risk, you are dramatically amplifying your ability to compound wealth for the long term. You have just invested a significant amount of your time and attention, and that investment has paid off. You have now acquired a powerful, multi-layered mental framework for making investment decisions, the very same framework that has guided one of the greatest capital allocators in history. You've learned that the first hurdle is always internal, the discipline to stay within your circle of competence. You now have a litmus test to distinguish a simple, solvable 1-foot hurdle from the siren song of the 7-foot turnaround. You understand that a durable economic moat is what shrinks problems, and you have a checklist to identify it. You know how to look for the honest, owner-oriented jockey and how to use the final, critical discipline of demanding a margin of safety. This is not just theory, it is a complete operating system for building a portfolio of low-stress, high-probability winners. But it is crucial to understand that Warren Buffett's system is not a collection of isolated tricks. It is a seamless, interconnected web of mental models. The principle you have just mastered, the 1-foot hurdle, is a powerful and foundational piece of that web, but it is still just one piece. It works in concert with other models, other ways of thinking about business, markets, and human psychology. Mastering this single concept is like acquiring one crucial section of a much larger map. It can guide you through a specific part of the terrain, but it doesn't reveal the entire landscape. To truly navigate the complex world of investing with consistent success, you must connect the piece you hold now to the other pieces of the map. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical step in your journey. Think of what you've just learned as one powerful link in a chain. That video is the next link. It holds the key to connecting the 1-foot hurdle principle to another core tenet of the Buffett philosophy, creating a stronger, more resilient mental arsenal. The journey from being a speculative gambler to a business-focused investor is a process of assembling these links, one by one, until you have forged an unbreakable chain of rational thought. The choice you face right now is more than just what to watch next. It is a decision about who you want to become. If you are content with having one piece of the map, then your journey ends here. But if you are committed to completing your arsenal, to seeing the entire landscape, to continuing your ascent toward true financial mastery, then your path is clear. That next video is not just a suggestion. It is the missing link. Complete the chain. Click and continue your transformation.